You want to buy a house in as-is condition? That can derail your entire financing position. All this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with back on the saddle with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
Hey, Gary. I'm well. How you doing?
We're hanging in there. We got the spring cold going through our household, but that's okay. That means summer is just around the corner.
Yes, let's hope so. It's been up and down. I know, from 19 down to 1 or 0 in just a matter of 2 days, right?
It's wacky. As wacky as all the news headlines and everything else, you could say.
Yeah, maybe. It's what's going on in the world right now. I mean, yeah, actually we're talking about seasons, and let me just touch on this. I was having a conversation with a client the other day who has owned real estate for many years, bought and sold for many years, and we were talking about seasons. And as you know, in Canada, seasonality really goes on the seasons of the earth, right? Summer, spring, winter, fall, winter. But we used to be able to gauge things based on that seasonal nature, because when it's cold, people didn't buy. But it seems like now the real estate market is not so much controlled about the seasons of the earth, but the seasons of the economy, if you know what I mean, right? And that is like what is going on in right now. Are we in a spring, a summer, a winter, or a fall as it relates to the economy? And I think right now, if you were to look at where we are economically, the writing is on the wall that if we haven't yet officially been announced that we're in recession, we're certainly on the way. So it's almost like we are in the fall of the economy and very soon entering the winter in terms of recession. And, that with it brings some interesting, challenges, no doubt, but opportunities for others as well.
Yeah. While you're talking about that, I was trying to look up a book that came across my desk probably 10 or 15 years ago, and it's called the Real Estate Cycle, and it might be by Don Campbell, but I'm trying to find it. Anyways, I'll put it in the show notes for later, and it's a great explanation of, that's kind of the normal, not only real estate cycle, but economic cycle, just as you're saying. Yeah. Sometimes our economic cycle goes faster in some regions than other regions, and it's important to kind of be in tune with that. It's not... we are, and we admit that right now we're kind of in territory we've never been before with, being pushed by different countries and tariffs and everything like that. But it is the economic cycle that just kind of happens every, the real estate clock, if you will, right?
Yeah. And I mean, a good way to measure that too, Gary, I know you mentioned you got some data as it relates to days on market.
Yeah. So
months of supply, rather.
Exactly. As we all know, every real estate board does this about 2 weeks after the previous month has ended, approximately, maybe sometimes shorter. We get the data from the previous month, and of course, the Toronto Real Estate Board is no different. And I know we're kind of at the end here, or creeping up to the end of May, and I'm sharing and looking at the April stats, and I was looking at it. In April, we had approximately just over 5,600 homes, all types, condos and freehold, sell, which is down somewhat year over year. And so, what does that number mean? Well, I think a good balance, meaning, okay, what's 5,600 solds mean? How many current listings are there in the entire Toronto Real Estate Board? Now, Toronto. We always think downtown Toronto, CN Tower, and the whole thing. The Toronto Real Estate Board is a large area, my friends. It goes basically, let me just pull up my map here just so I can see it on my screen, basically from Burlington all the way over to Bowmanville, so that Curtis area, Oshawa area, and a little bit further east, and all the way up to Midland. So for those that know, that's a big geographic area. We are the largest real estate board in the world. Currently, Dion, there's over 37,000 listings, both condo and freehold, on the Toronto Real Estate Board right now, which is to say, if we've had 5,600 homes sell the previous month, You kind of divide that by the
Right.
37,000, and that's approximately 5 months, or five, a divider of five. 5 months, sorry, excuse me, my math is terrible.
Seven months.
Seven,
Okay.
7 months of inventory,
Right.
which is creeping up there. We've not seen that for quite some time, and that's going to feel like a lot.
So that means, just Gary, in layman's terms, if no other properties came to market and we only had what is on the market, it would take 7 months for all of those to be absorbed by the buyers. Yep.
Yeah,
So that's what months of inventory represents. And I think that balanced market is at about 5 to 6 months. And
yeah.
now we're in that. Yep. So now we're in the 7 month uh, lag time, so to speak. It looks like well and truly that needle is pushing in favor of the buyers. Yeah.
Absolutely, absolutely. And if you're not having these conversations, A, as a listing agent, or B, buying agent, or you're the buyer or seller specifically, this also helps set that expectation, and also your pricing conversation, your offer conversation. How long has this home been on the market? There's all sorts of questions that you would want to ask about the specific listing that you're dealing with, whether you're in the buy or the sell side. And it's important to know sometimes, not sometimes, all the time, this data. And what's the competition doing? How's their pricing? What does this look like now? Dion and I are talking big picture, 30,000 foot view. This might not be specific to your neighborhood or your street. So make sure you get that data. If you're about to list your home, and you might say to yourself, well, Gary, the home around the corner took 10 months to sell, or the one around the corner took 3 weeks to sell. Let's make sure we get that specific data.
Yeah.
This is what
And
it
in
looks
fact,
like on
just
the big picture.
anecdotally, I just got off the phone with a realtor before this call, and he's saying that he's got a buyer who he might send a new listing to on a Tuesday, and it's a good listing that they would likely buy, but the buyer's busy, and therefore they're not able to get to the property till Thursday, and the property sells on the Wednesday.
Yeah.
So it's still very much property based, price based. Like, what are you after? And I dare say that detached ground-based properties are still more scarce than the others, and they're still more desirable by the general market than the others. So, yeah, that just be careful in assuming that things are going to be easy. It just depends on where you're buying, what you're buying.
Yeah, exactly. Well said. Okay, let's move on with some incredibly important information as you're dealing with your clients on a daily basis from financing. And one thing, excuse me, yeah, I am
No
dealing
worries,
with
man.
that cold.
I know you
One
haven't been
thing
well.
that comes up in listing descriptions all the time when we're browsing, we're doing the scroll and reading that, we're like, oh, look at that property. One of the things that Gary and Dion say is, how can I add value? And one of those things that comes up all the time is property, blah, 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 as is.
As is, yeah.
And that might be a red flag or a green flag, depending on how you look at it. Dion, how do banks look at the
Yeah.
as is
So
phrase?
from the bank's perspective, the words "as is" followed up with other words such as "renovator's delight" or "contractor's dream." Right? All these words are red flags for a lender. Okay, and it's not because the property is necessarily in bad shape, but when those words are used in an MLS description, the lender must think the worst. Okay, they're trained by their guidelines to look for these words, and therefore, this property comes under greater scrutiny. So from a seller's perspective or selling agent's perspective, they may be like, okay, well, let's throw this out there. This is a great deal for an investor, contractor type person. What the lender makes that mean in their mind is that this property may be so bad in its current condition that it is not habitable. And this is a key word in the lending world, habitable. Is the property one where the day the buyer gets the keys, he can literally move in and comfortably live in the property, right? And I had a client recently come to me and say, Dion, I bought a property. It says as is and whatever, but it's just missing a toilet. And I'm going to put the toilet in on day number one. And I'm like, well, I'm sorry. The minute that you get the key, the property doesn't have a toilet. And so the lender is not going to say that this property is habitable, right? So in that particular example, we had to close with a private type lender who was fine with the state of the property. And then we refinanced it over to a major bank. But back to the as is, which is especially I'm working with a lot of first-time home buyers who obviously in the current market are looking for lower price points, more affordable numbers. And in doing so, they're looking for maybe a fixer-upper, again, which I understand is fine. But I had this conversation with a client last week who he was going after a property that was under power of sale, which is the lender, in that case, it was actually TD Bank as the seller, was selling that property as is. And that property had a sliding door on the second level kitchen, and the sliding door opened up to nothing. There was no deck. So the sliding door opened out to death, basically. And, and because of this, yes, it was as is. Yes, the client could have bought it and spent 5 grand building a deck by himself, and it would have been safe. But again, because of the state of the property, not livable day one, not safe day one, lenders will not take on that type of risk.
Yeah, we, as listing agents, we think we're all smart and everything like that, but we could be shooting ourselves in the foot based on the financing piece. So make sure that you are in full. You have all this information when you're looking at those types of properties. It is incredibly important.
And I'll just say this: on the flip side, sometimes sellers and under power of sale, they have to put as is, right?
Yes.
Legally, they have to. It does not necessarily mean that the property is unlivable, right? It may very well be habitable, but you would need to go there with your realtor, walk the property top to bottom, look at it through the critical eye that a building inspector and or an appraiser would look at it. And if you think, okay, you know what, I know it's sold as is, but there's really nothing wrong with this place.
Yeah, and
Certainly, you can buy that. Just know that there's going to be an appraisal, and if the appraiser catches anything negatively, then the financing could fall over.
yeah, and maybe we spend some time on power of sale in one of our other videos, or foreclosure, depending where you are in Canada. Typically, at least in the Ontario perspective, power of sale property descriptions come from the lawyer. They don't necessarily come from the listing agent. The listing agent might put together a paragraph or two and send it to the lawyer, and then they'll add their legalese, if you will, back to it. And they don't want to. The bank will not take on any sort of liability. They are pushing everything away, and that's why you see as is. Let's just land here. We'll finish off with this. We often see things like water softener or dishwasher in as is condition. That's not precisely what we're talking about here. We're not talking about some of the appliances or things like that. We're talking about the actual state of the home.
Yeah, correct. And to be clear, and just I'll get into the weeds a little bit here. A thing like a dishwasher is not a structure that is technically permanently attached. It is an appliance. Appliance falls into a category called chattels, and chattels can be moved. So we're less worried about things that can move in and out of the property. We're more worried about structure, safety, and health. They're the big things that people look out for.
Good. Now, you did mention appraisals when you were talking there. And one of the things that you mentioned to me off camera here is for new constructions, new construction purchases, we'll often see appraisals. And those appraisal numbers are incredibly important to the financing piece. Talk to us about what's happening there.
Yeah, so look, if we were to go back, say, 10 years, and you imagine buying a downtown Toronto condo for $500,000 in the year, call it 2015, and you didn't have to close on the purchase until 2018. What happened is you paid 500 3-4 years ago. You went to close on it, and in most cases, that $500,000 property was worth about 600 the day you got the keys, right? And this is where people were basically making 100 grand for having signed some paperwork just a couple of years ago. And a lot of people made a lot of money doing that. Now, when we get to the years 21 and 22, where we were at the absolute peak and FOMO frenzy that existed, people were lining up as they normally did outside these pre-construction places, signing purchase agreements, again with that expectation that I signed for 800 grand and it should be worth 900 grand by the time I need to close. Unfortunately, what happened is interest rates went up by about 5%. That drove prices down and basically have kept people out of the market. And here's a real example, Gary. So Yesterday, I was talking with a client who bought that pre-construction. This was a townhouse in Oshawa for $870,000. Okay. At the time, it made sense. When we got the appraisal report back, it came in at 715,000. Okay. And when we see appraisals, we always see if we can challenge them in any way, but this was a fair appraisal based on recent sales. So we were short 155,000. Okay. So that's the shortfall that the client has now. Just keep in mind, guys, no matter what you paid for the property, the lender is going to base their lending decision off the lower of the price you paid or the appraisal. In this case, the appraisal is lower, so they're going to get 80% of the appraised value, not 80% of the price you paid. Basically, long story short, this client needs to come up with about an extra $150,000 cash down payment in order to close. Okay. So this is one example, but I can tell you I've dealt with dozens of these in the last year or so, where unfortunately, because of the turn of the market, people are having to come up with more down payment because the appraisal is coming in short. And in most cases, we are able to find solutions for this. And in his case, we are accessing equity in a different property that we're going to basically grab and use as extra down payment on this new property. So there are ways around this. I will say this: I speak with a lot of lawyers, and some people think that, some buyers think, oh, I'll just walk away. You know what? The appraisal's coming short. I'm just going to walk away from my 50 grand, 100 grand deposit. I can come to peace with a 100 grand loss. What they don't know is that the seller, that is the builder, can come after you, the buyer, for walking away beyond the 100 grand down payment. And I just spoke with a lawyer recently who has 11 of these cases on his desk at the moment, where the buyers said, I'm going to walk away, but the builder has in fact come after them for not just that difference. But in this case, for example, let's say that this buyer is going to close. I want to be clear. My buyer here, he will close. But let's say that he chose to walk away from this deal, and the seller kept their original deposit. In his case, it's about 170 grand. That's a lot to walk away from. But let's say now the seller, that is the builder, sells the property at 715, okay, which is 155 grand less than the contract price that the buyer agreed to. Well, the builder can now go after that seller who walked away for that additional 155. So in his case, you're looking at 300 grand as your potential loss here, not just the original 170 grand.
Yeah, I've often sat on webinars and such for that very topic, walking away from those types of properties. And the lawyers will always say, do everything you possibly can to close on it, because walking away is going to be is actually going to hurt you more. And that's a whole other topic. Okay. Let's talk about, we've all heard the phrase and the token slang, dad math, mom math, girl math, all that type of thing. There's such a thing called mortgage math. Talk to us about mortgage math. Yeah.
Yep. All right. So I want to give everybody listening, clients and realtors, some really basic numbers that you can carry around in your brain when you're looking at properties and looking at prices. Okay. And the simple one is, Dion, how much does it cost to borrow $100,000? Okay. So this number will depend on what type of mortgage you're getting, what interest rate, amortization. But what I will tell you right now is, across the board, for the most part, if you're a regular client buying with a regular bank, a $100,000 mortgage costs you about $500 a month if we're taking a 30-year amortization. Okay. So just lock that in. 100 grand costs $500 a month. Okay. Now, I was just talking with a client this morning. She's a doctor, and she was looking to try and get approved for $800,000. She had spoken to her bank, and her bank had approved her for $700,000. So she was 100 grand short of the number that she needed. Okay. At the same time, she was putting down a large down payment. She was putting down 250 grand. And when we did some quick math with her, we realized that she had a car payment, and that car payment was $800 a month. Okay. So remember my math there earlier. 100 grand mortgage costs you $500 a month. That $800 car payment robbed her of $160,000 of mortgage borrowing power. Okay. So we looked at her math, and I said, look, here's what you could do. You could pay off your car and in doing so, eliminate that $800 payment. By doing that, we boosted her borrowing power on the mortgage side. And yes, she would put a little less down payment, but she would actually get to the $800,000 number that she needed. And so it's really important, if you can just imagine this, every $500 is 100 grand. Alternatively, every $10,000 is $50 a month. Okay. And I was just chatting with a younger couple recently who were really sort of torn about whether or not they should pay this extra 10 grand for this property. And I said, you and I, we're talking about 10 grand here, but what we're really talking about is $50 a month. And so is this property worth an extra $50 a month compared to the other properties you've seen? And in their case, they said, yes, 100%, this is worth $50 a month. So we sometimes get caught up in these tens of thousands of dollars number when we really need to just look at that monthly payment and see what that does for you.
I like it. Mortgage math. Mortgage math is important, especially when you're looking at buying a big purchase, obviously like a home, a condo, which have you. Understanding, what other monthly payments do to your borrowing ability is actually, sometimes for some that have not had that conversation before is quite surprising to them, I would imagine.
Oh, yeah, yeah. And again, this is a doctor. She's a intelligent, educated woman. And she said, Dion, I spoke to my financial advisor and I spoke to my bank mortgage advisor and nobody told me this. And it makes so much sense. Yeah. And so, yeah, these are the conversations that we love to have, where we show people how to look at the problem and approach it a different way. And in many, many cases, we find solutions that others don't see.
Excellent, my friends. Excellent. Okay, remind everybody how to get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Beg.
There you have it. That's the Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.